My daughter's birthday.
Oh, it is. Oh, happy birthday to him.
Yeah, we've just been doing things all weekend, so.
Did you say daughter or son?
Daughter.
Daughter. Happy birthday to her.
Yeah.
Okay, very cool.
Yeah, not.
Did you get the bouncy house and the clown and ponies and stuff?
We had Elsa. Come by.
Nice.
Yeah. Well, she had some time in her schedule to come by.
No. All the way from the warmer weather.
Yes. Yeah, but you know how that is.
Nice. Well, that's cool.
Yeah.
As long as it's not an ex-con in a suit, you're good to go.
No, she was definitely a girl. Well, maybe they could be ex-cons, right? So we got an interesting market. I saw your call this morning. You were looking for a nice breakdown to 65, and then let's pick up here. Let's just pick up what we got going on.
That's right. First of all, derivatives trading is not suitable for all investors. Past performance not indicative of future results. I'm required to say that. The plan for today, according to the pre-market trader bite, was for a drop, a test of the overnight high, which is at 70.50. We went to 71 by 2 ticks, so that's pretty good. In case you needed a fill, you got it there. And then for it to drop back down to 65.25. Once it drops through to 65.25, the key element there was to watch very carefully. 65.25 was a point of control from way back from the 30th of September, and once it tested it, had to watch very carefully to see if it'll actually break into Friday's range. The range high of Friday was 64.5. And then the goal, if it breaks down through 64.5, was for it to hit to test out this 60, which we just did.
Yep.
We went through it by 3 ticks. So the expectation from here, if it has any room to go down, the expectation is for a test of the 58.5 area. Otherwise, I'm expecting this to chop around here before buyers step in the afternoon and take it back up to continue this run up. I expect that, we still have room to 72.25. I listed 72.25 on the sheet. It's really 72.25 or 2 things. One, that day where we made a V bottom last week on the 2nd, which was Thursday, we sold off from 42.5, went all the way down to 18.25. Last Thursday, and it came all the way back to 45.25 on the high day. See that?
Yep.
See that right there? The neckline. If you project the neckline from the head, you have an inverted head and shoulder there.
Yep.
If you project that up, you get 72.25.
All right.
Which lines up with a profile level that I have from the 30th at that exact same price, 72.25. So the push-up this morning was expected, if it was going to go through the overnight high at 70.50, the push-up was expected to kind of see some resistance at 72.25. Couldn't quite get there. It stopped 5 ticks ahead of that, rotated down. But the key trade idea of today was what just happened, which is to break down to 65.25, linger a little bit, then break into Friday's range down to 60, and then chop around, and we're in the chop zone now.
Okay.
So if you pull back, you'll see that it's kind of it's broken through by 3 ticks through that 60, and it's kind of reversing back. I expect initial resistance to be that little double bottom you got there at 10:30. You see that those 2 bars?
Yep, right here.
Yeah, I expect it to. I see you have a moving average there, an orange moving average as well. They're coming in.
Yeah.
So I expect some resistance, a little bit of resistance there, short term. But if it breaks out at 64.5, if it breaks above 64.5, then I would caution the shorts, because it's likely to test 68.5 next, and then new highs by the end of the day. I'm not saying that's what will happen. I'm saying if it gets out above 64.5, 65, I would be very cautious if I were short.
Good. Well noted. Big day on Friday. Big reversal. How'd you like that day?
It was great. It played out. It played out exactly as I had planned. Actually, almost to the tick. The expectation on Friday was for it to open above Thursday's high, which was 45.25. I expected the same kind of thing as today. I expected it to come back and touch the 45.50 high. It stopped by a tick, or this 45 quarter high. It stopped at 45.50. Buyers loaded the boat and rode it back up to 1960. That initial high on Friday was 1960, and that's why we carry that to today, right? So same thing as today, sort of, but Friday was expected to be a continuation day after the V bottom Thursday. So it just played out perfectly. The target for Friday was 65. You know, those levels sound familiar for today. Essentially, today was the same plan as Friday, except upside down because we're coming from the top down. Whereas Friday we started below it and moved up to it. But it's basically the same plan in reverse. So Friday was pretty cool. It you know, the non-farm payrolls trade was quick but decent. So there's a lot going on there. But today there's nothing on the calendar, so the market's free to kind of float and do its thing under its own power, as opposed to some external thing pushing it around.
Let's go back to Friday a second, because it's a great example of what you usually talk about when you do have that Fed number come out and stuff. We saw that reactionary trade, and then we saw that the market kind of grinded up to that spike high right here. I have it on the screen. This is we came out, the initial news that came out at 8:30.
Right there,
we spiked lower, then spiked higher, and we had this big range. And then what happened? The market here kind of stair-stepped its way up there. And it was a weird type of trade. It just kind of grinded up there until we tagged that level and then dropped off. And we ended up coming all the way back down to that range about 940 and then moved up. So we kind of...
And look at, look at what it did. It tested... This is what we talked about. When was it? Last week or the week before? That revisiting the scene of the crime, like a criminal does, right? So it tagged the high of the range, and then on the open it tagged the low of the range. So what that's saying is, here we got an economic release. We got a big flutter. There was a decent range there, maybe 6 points or something, and we didn't. When that happens, the market doesn't really auction properly. It's kind of like watching gas prices go from $3.50 up to $5, down to $3, and then settling at $3.75. There's no real buying or selling that happened. Like, there's not a proper auction that happened in those areas. And so generally what the market does is it treats that almost like it treats a gap, where it's not known who still has interest in those prices and who does not. And so generally, not always, generally it'll start to float up and down to these prices to check them out. You'll see the same thing on FOMC day. Although on FOMC day the market's more directional, but it does come back and recheck those levels over the next few weeks or whatever, or next week. It does that a lot, where if you have a flutter, a quick move, the market tends to kind of move to those extremes and kind of almost make sure that those are good levels before it actually picks a direction. And you can see a perfect story there on Friday.
Yeah, it seems like it happens so often that it could actually be a trade technique, just being able to, take the level, if we haven't gotten down to that level, expect that level to be tested and maybe take a trade in that direction.
I always mark the high and the low of the initial move. So the first couple of bars, I always mark the high and low of Fed day and FOMC day on my charts. Those are important levels because you have there's some logic behind this. You have the bigger players. So we're always, like, when we're looking at market volume profiling, really the biggest job we're trying to accomplish here is to detect and track when the bigger players come in, because that's how you catch a big move. You're on the same side as the bigger players, and if a number comes out like FOMC or some other big release, especially non-farm payrolls or FOMC, that's the bigger player acting. That's the bigger player kind of managing positions, moving money into risk out of bonds or notes or whatever treasuries there are, moving them into riskier assets or moving money out of riskier assets into those treasuries, depending on what the perception is of what the future holds in our economy. Those are big areas. Those are big events that allow us to take a very clear shot of how the money is moving around, and it's a higher time frame. So recognizing that and kind of highlighting that on your charts really important, because we see the footprint. That's like a very clear footprint of when the bigger buyer or the bigger seller stepped in, and we want to know those areas. You want to box those areas in and see how the market reacts when it comes back to those areas. And generally, if the market comes back to those areas, it tests the other side. You know, so we're above NFP now. If we fall back in, we've already done this test, so it's not likely this will happen again. But once we fall back in, you know, the first time below the high made on non-farm payrolls, then there's a high probability, and I tested this back in like 05 or 06 on a statistical study, there's a high probability that it tests the other side of that level, that footprint that it made, you know. So that's why I kind of outline that all the time.
Yeah, that's a good one. It was a good example of that. So, and then what else we have here on the chart? Someone asked in the room here before. I want to just relay this question. If I can go back here. Who was that? Papa here. FT71, why did you expect deeper pullback into Friday's range rather than just a Friday's high?
Okay, so we've done the Friday's high game already. So Thursday, that V bottom from 18.25 on Thursday that went up to 45.25, that was an impulsive move. That was the first time in the last week. Remember, we started selling off on October 1st, basically. That was the first time in the last week where we saw buyers come in and just take the market back up. Before that, it was allowed to go sideways with a downward skew or float down. That was the first time we saw a big push up. Because it's the first time we saw a big push up, I call that an impulsive move. That is like the first push. That is the smart money kind of having gotten in and is finally pushing prices through. Generally, you expect a second leg of that, which is called a continuation or the extension move. The continuation or extension move came on Friday. The first move on Thursday, the second move on Friday. Today, even though it's gapping above because we traded higher with in sympathy with Europe overnight, we've already kind of exhausted that fuel, the buying fuel. So the expectation was we opened higher. The expectation was a minimum of a test of Friday's high, and then I have to sit here and watch to see, does the market fall into Friday's range? Does it fall below that 64.50 high we put on Friday? Once I see that it's falling in, then I look for Friday's targets, which was 60 even, which we tested, and then the next one down is 58.5. We stopped 3 ticks of that. So it's kind of a, it's not really a crystal ball, let me shake this ball and see what answer gives me or anything, and it's not some secret sauce that predicts the future. It's basically saying, this is what's happened, and given what's happened, here's the higher probability, or here's what's likely to happen. And then the next job, and a lot of traders actually miss this, your next job is to just wait for the market to tell you what it wants. Like, you've already created a plan. It's almost like laying a mouse trap. You know, you can lay a little mouse trap and you say, well, I see a pattern here. I see whatever, some evidence that there's a mouse, you know, moving in this path here. Let me put some cheese here and see if it nibbles. If it does, then I'm going to lay my trap down the track over here. Like, you're just reacting, having a plan, and then being ready to react once your plan is taken up by the market. Then you basically say, okay, if it does that, then here's my entry method. My entry method is, once it tests into Friday's range, I'm going to sell the first pullback, expecting it to fall through the range, and then my target's going to be 1960.
Now, I just want to point out also, because when we get those levels up there, we always look back at the patterns that we have on the charts, and this was a really beautiful channel that was playing out here. I could actually make this one blue to kind of, you know, show you the whole channel, but you could see this beautiful channel. We've been tracking this channel, even this little breakdown here, which came within, you know, that I consider this, there was some news out there. There was the Ebola in the U.S. and stuff, and the market flushed out real fast and then corrected back in here, and we got back up here. And whenever we see this breakout, what I normally look for is that retest of that channel, and that happened to be basically right in line with that 1960. So it's funny how, that's why I love combining your profile lines with our charts, and it just seems like if you have everything lining up, we consider that a higher probability setup, as the profile lines is a good indication of levels to watch.
Yeah, and you know what, John, just dealing with online traders now for a couple of years, there's this misperception, like with your HPS, your subscriber numbers that you put up, the trades that you put up in your on your dashboard here and stuff that I'm looking at. There's a misperception that those who trade have some sort of a system that predicts the future with certainty. There's a missing idea that actually very few people, or pretty much other than Janet Yellen and her crowd, they don't, nobody else really knows with certainty what's going to happen. The name of the game here is to try to find something that gives you a good probability, and then to bet on that, and only bet on that. Yeah. And if you're wrong, you're wrong. It doesn't always work, and that's just part of the game. It's like playing a hand of poker. Exactly. You bet the minimum every time until you see that, wow, I've got 3 aces.
Yeah. Yeah, this is yep.
And then you say, okay, what beats that? What beats that? And look, I have an 82 or 86% probability that everybody's hand is worse than mine. I'm all in. Yep. But we don't do all in. We make it so that even when the probabilities are great, and strong on our side, we bet enough to be able to stay in the game even if we lose that amount that we bet. Because the name of the game is a lot of bets over an extended period of time to see your edge come up, and most people bet too much.
Exactly.
On something.
100% agree with you 100% on that whole thing. It is about it's the number game. It's a numbers game. You take enough good trades, the probability is going to work in your favor without blowing up before that time comes, because some of them will, you will get caught in news. I mean, imagine the people in GTAT from Friday going into today. I mean, they just got crushed.
Yeah.
They halted. It's down 90%. It went from $11 to $1. I mean,
your stop is not going to help you in that circumstance.
You're crushed. Your day is ruined, and it's just over. So you want to be able to have the people who make it in this game are the ones that have the discipline not to get into spec plays where you put yourself on the line like that. I mean, that's just a roll of dice. Eventually news is going to catch you in something, but you want to be able to have the best possibility and not be overextended.
Yeah, and there's there's no denying that there's a gambler within each one of us, and we all feel the endorphins and the thrill of catching a big one, but you know what, that big one that you catch, you might make, let's say, $1,000 on it, but your brain forgets the fact that you've invested $15,000 on really bad ones playing that same game. You just remember the one that made $1,000, and you keep playing that. It's just really, really important to understand that you're here. Your job here is to take as many small bets as possible. And not to let one bet steal your entire wallet. That's not sustainable. The risk of ruin in those circumstances is extremely high. So even as I read the market here, I know that my next trade can be a loser, and so I cannot commit more than the minimum to that trade, even if it runs for 20 points on the S&Ps. It doesn't matter. I'll take what I can get, because the name of the game is to stay in. Now, the difference between a guy who's a trader who's looking to figure this out and a trader that's done this a while is that you start to develop a sense for when you hit the gas on certain trades. Like there are circumstances where you can bet a lot bigger. You can put more of your account on the line, but it's because you've put yourself in a position where your risk is already minimized because you've already taken some profits, and you see that the trend is continuing, and you can add on, and I call that campaigning. That's, big traders. I'll tell you, I've been around big traders pretty much since I started trading. Big traders, their biggest winnings are done in a short period of time in the year. The rest of the year, they'll tell you that they're just kind of grinding and living out.
You wait for that opportunity and you make your money, and then you have to have the discipline not to try to relive that glory. And you don't want to search it. Yeah,
exactly.
It'll come.
Exactly.
Well,
very cool.
Excellent, FT. Always great to have you on. I got your information. We're going to send it out on the newsletter, and again, of course, FT71 here from Stage 5 Trading. And if you want to learn more about that, it's very easy to get in touch with him. He makes himself visible on all kinds of streams. It's FT71 Twitter feed at FT71 Stage 5 Trading. Just go there, and make him part of your trading platform.
Very cool. Thanks so much, John.
All right. Thanks.
Take care.
Take care. All right. Let me actually starting to record these little segments also to put out for people if they like that, if they miss it. So let me just stop that and